The US economy continues to create a solid number of new job positions. Friday's non-farm payrolls report showed an addition of more than 200,000 in June, slightly higher than what analysts expected, but the unemployment rate continued to rise to 4.1% and slightly faster than what analysts expected. So that made investors think that a September rate cut is now more likely. What remains to be seen now is whether Fed Chairman Jay Powell will support a September rate cut when he testifies before Congress on Tuesday. So Tuesday's testimony will be a key market moving event for the dollar pairs, and we shouldn't forget that the next CPI inflation report out of the US will be published on Thursday, so that could also affect the rate cut expectations. Elsewhere, we have a central bank meeting in New Zealand, so the New Zealand dollar might attract special attention this week, and UK GDP monthly figures will be out this Thursday, so that could affect British pound pairs following the election of a new government last week. So at this video, I'll briefly discuss my outlook on dollar yen, pound dollar, and Kiwi dollar. Starting first with dollar yen, we can see that the pair didn't face significant declines following Friday's non-farm payrolls report. Despite the increase in the unemployment rate, the pair is still around the 160.20 level, which is the peak from April. We saw the pair bouncing up around this level back in June, so that sustains optimism for an upside reversal despite the negative negative turn in the RSI and the stochastic oscillators. So if the pair manages to hold above 160.20, I would like to see a decisive rally above this former resistance trend line coming from October 2022, that is at 161.25. If that happens, and if we run above July's peak of 161.94, then we may see, then the next resistance could emerge near the 163.68 level, where this thin resistance trend line coming from the start of the year is placed. Above that, I believe that the next stock could be somewhere between 164.70 and 165.35, because this is where this constraining ascending line from March is located, as well as the 161.8% Fibonacci extension of this downfall. And now looking at pound dollar, monthly GDP figures are expected to show some improvement, but overall the UK economy could show a sluggish performance for the month of May. So perhaps the pair may not pay strong attention to the data, but overall a positive surprise could add some support under pound dollar after the Labour Party won the general election last week. We have a change in the government, so that could bring some relief to the British pound. Looking at the pair now, we can see that the pair is approaching June's high of 1.2859, so a close above it could take us up to 1.29, and above that the next resistance could occur somewhere between 1.30 and 1.3020. If you look at the technical indicators, there's opportunity for more improvement given the positive slope in the RSI. The stochastics are also trending up, but they are already within the overbought region above 80, so that suggests that bullish actions might emerge at a softer pace in the coming sessions. Nevertheless, if the price fails to close above 1.2859, we may see a pullback to 1.2765. This is where this resistance trend line from May 2021 is located. Last week's break above it increased optimism for more upside, but if we fail to hold above it, that could attract first selling, likely bringing the 20 and 50-day moving averages back into view at 1.2717 and 1.2680. Further below the 200-day moving average and this support trend line from 2022 could be a more critical support region. We saw the price bouncing up around this line back in April, so that region could be closely watched before the focus turns to the 1.25 or 1.2535 territory. And finally, looking at Kiwi dollar, well, the Reserve Bank of New Zealand is not expected to cut interest rates, is not expected to change interest rates overall, but it will be interesting to see whether policymakers are still thinking about rate hikes during the central bank's policy back in May. Policymakers discussed about the potential for a rate hike after inflation proved more sticky. So this week's meeting, it will be interesting to see whether policymakers will retain their hawkish tone if they talk down any rate cuts that could still allow Kiwi dollar to run higher. We saw the pair facing a nice recovery last week, but downside risks are still in play given the fact that we haven't surpassed this resistance line from February 2021 at 0.6188. So I would like to see a break above it and then an extension above June's high of 0.6220 in order to target the next resistance at 0.6277 and 0.63. Well, from a technical perspective, there is a risk for more upside. We can see that the RSI is above 50, the stochastic oscillator is trending up, but again here the indicator is within the overbought zone, and the MACD has yet to show any meaningful progress. So that suggests that selling interest is still in play. If the price reverses to the downside, crossing below the 20 and 50-day moving averages at 0.6120 and 0.6995, then perhaps the focus will turn to this tentative support trend line, which is located near the 200-day moving average at 0.6070. Below that, the next stop could be somewhere between 0.60 and 0.6030. So that's all from me today. Thank you for watching and see you next time. Bye bye for now.